Hi. Let's learn about delta in derivatives trading and how it works. Delta is a risk metric that estimates the change in the price of a derivative, such as an options contract, given a $1 change in its underlying security. It is represented by the symbol delta. The delta also tells options traders the hedging ratio to become delta neutral. A third interpretation of an options delta is the probability that it will finish in the money. Delta values can be positive or negative depending on the type of option. Delta is an important variable related to the directional risk of an option and is produced by pricing models used by options traders. As noted above, it is represented by the symbol delta. Professional option sellers determine how to price their options based on sophisticated models that often resemble the Black-Scholes model. The calculation of the delta is done in real time by computer algorithms that continuously publish delta values to broker clientele. The delta value of an option is often used by traders and investors to inform their choices for buying or selling options. Delta spreading is an options trading strategy in which the trader initially establishes a delta-neutral position by simultaneously buying and selling options in proportion to the neutral ratio. Using a delta spread, a trader usually expects to make a small profit if the underlying security does not change widely in price. However, larger gains or losses are possible if the stock moves significantly in either direction. The most common tool for implementing a delta spread strategy is a calendar spread, which involves constructing a delta-neutral position using options with different expiration dates. Call option delta behavior depends on whether the option is. The delta for a call option always ranges from 0 to 1 because as the underlying asset increases in price, call options increase in price. Put option deltas always range from -1 to 0 because as the underlying security increases, the value of put options decrease. Put option delta behaviors also depend on whether the option is. The deeper in the money the put option, the closer the delta will be to -1. If a put option has a delta of -0.33, and the price of the underlying asset increases by $1, the price of the put option will decrease by 33 cents. Technically, the value of the option's delta is the first derivative of the value of the option with respect to the underlying security's price. Delta is often used in hedging strategies and is also referred to as a hedge ratio. Let's assume there is a publicly traded company called Big Corp. Shares of its stock are bought and sold on a stock exchange, and there are put options and call options traded for those shares. The delta for the call option on Big Corp shares is 0.35. That means that a $1 change in the price of Big Corp stock generates a 35 cents change in the price of Big Corp call options. Thus, if Big Corp's shares trade at $20 and the call option trades at $2, a change in the price of Big Corp's shares to $21 means the call option will increase to a price of $2.35. Put options work in the opposite way. If the put option on Big Corp shares has a delta of -65 cents, then a $1 increase in Big Corp's share price generates a 65 cents decrease in the price of Big Corp's put options. Delta is used by options traders in several ways. First, it tells them their directional risk, in terms of how much an option's price will change as the underlying price changes. It can also be used as a hedge ratio to become delta neutral. For instance, if an options trader buys 100 XYZ calls, each with a +0.40 delta, they would sell 4,000 shares of stock to have a net delta of 0. If they instead bought 100 puts with a -0.30 delta, they would buy 3,000 shares. Traders that have several options positions can benefit from looking at the overall delta of their portfolio. If you are long one call with a +0.10 delta and two calls with a +0.30 delta, your total book's delta would be +0.70. If you then bought a -0.70 delta put, the position would become delta neutral. Derivatives are financial contracts whose value depends on an underlying security or benchmark. These contracts can be used to trade any type of security, including stocks, commodities, and currencies. But they do come with certain risks. Traders who deal with derivatives should understand these risks and how to measure them. For instance, knowing how to interpret delta can mean the difference between realizing gains and losses. Remember, delta is a risk metric that indicates changes in a derivative's price based on the price of the underlying security. Here are 4 key takeaways. 1. Delta expresses the amount of price change a derivative will see based on the price of the underlying security, e.g., stock. 2. Delta can be positive or negative, being between 0 and 1 for a call option and negative 1 to 0 for a put option. 3. Delta spread is an options trading strategy in which the trader initially establishes a delta-neutral position by simultaneously buying and selling options in proportion to the neutral ratio. 4. The most common tool for implementing a delta spread strategy is a calendar spread, which involves constructing a delta-neutral position using options with different expiration dates. Hope this would help. Thanks for watching.